Hi traders, and welcome to my video on the Donchian Trend Ribbon Indicator. This is an indicator for the MT4 trading platform. You can probably find it for other trading platforms as well. In this video, I'm going to show you how you can use this indicator to capture moves like this one for over 600 pips and counting. So you can see the Donchian Trend Ribbon Indicator attached there below my chart. Okay. It's very simple to use. Basically, what you're looking for is when the histogram is all red, it suggests a downtrend, and when it's all blue, when it's all green, it suggests an uptrend. You can amend the colors from the EA inputs, okay? It will also display an arrow on your chart when there's a signal as well. By signal, I mean once they all change from one color to the other. For example, here, you can see there's a red arrow when all of the histogram is red. Okay, and here you can see there's a green arrow when all of the histogram is green. So I'm gonna, in this video, show you how you can implement this indicator within your trading strategy to capture some big moves, big market trends, and potentially bag some big pips. One thing I wouldn't do, and that is buy every time there's a green arrow and sell every time there's a red arrow. Okay, as you can see from this example here. You wouldn't want to buy when there's a green arrow there. You wouldn't want to buy a green arrow there. You probably wouldn't want to buy a green arrow here. Why is that? Because we're in a downtrend, okay? You can see that the market was making lower highs here. You had this nice wedge formation here, breakout to the downside there. Arguably, the initial breakout was here, this level, okay? I'll just zoom in to show you. So we had this triple top formation. The resistance has been touched at least 3 times. We draw the neckline, which is the support within the triple top. Had a breakout here from that candle, then a pullback. The support level became resistance. Okay, there. And then we could have just drawn our line of support along here, which was a nice breakout to the downside, which also coincided with the breakout of this particular trend line here. So all the signs were good there for a short trade. Confirmed as well by the Donchian Trend Ribbon Indicator, signaling there almost perfectly with that breakout. So that would have been good confirmation on that trade there. We zoom out. We could have actually taken that trade without the indicator, okay? Just based on the price action. For me, price action is the king of analysis. And by that, I mean support and resistance, trend lines, and candlestick patterns. We don't actually need any indicators if, in my opinion, we have good price action analysis and good money management. Talking of money management for this particular trade, had we taken this breakout here, looking around 15 pips stop loss, I would have placed my stop loss on the recent high. So between 15 and 20 pips, which is relatively tight for the 1 hour chart time frame. When you consider this move over 600 pips and counting, we would have been way up. Okay, on the way down, I would have trailed the stop as well. I would have just moved it above the most recent highs, following the price down, okay, above the most obvious highs, and just look to lock in as much profit as possible. You can always close part of the position on the way down, bank some pips if you prefer. Okay, had you missed out on this initial opportunity, the indicator could have waited for it to change the opposite direction, so green here, and then change again to red, okay? And that could have been another entry, as you see there on that breakout there would have been a decent entry. However, there will be instances you'll see where the indicator won't actually change that you may miss. If you're relying solely on the indicator signals, for example here, I can see that is a good level of support here, okay? Nice M chart formation as well. So I would have considered this after this nice breakout to the downside. Okay, the market making these lower highs, M pattern formation, support, and a breakout. I would have perhaps taken that breakout there if we hadn't already gotten in here. And if we zoom in, we can see bearish price action as well. Okay, some bearish candlestick formations, plenty of bearish price action around here. You can see, as I said, the market making these lower highs, nice wedge pattern there. Okay, resistance here, consolidation and breakout to the downside. As you can see from that big breakout candle there were traders waiting and ready to pounce on this particular move. Okay, so the indicator can be lagging in some instances there. It would have missed that opportunity. That being said, as we continue on down this trend, there would have been another opportunity there. I'll just zoom out for you. So the other opportunities were here. Again, this is why I don't rely solely on indicators. This one I would not have taken simply because I don't want to sell at the low of the move. You can see the market had already dropped down here. I would have waited for a pullback up here. And for sure, I wouldn't want to sell into this area of support. We'd wait for a breakout here. Okay, so one could argue this arrow would have been a valid signal just because you've got this level of support here. Okay, we could have looked to enter. Sure, if we zoom in, we can draw more immediate support there. Okay, and again, market making these lower highs. Got your wedge formation. I do have videos on the wedge pattern and various other chart patterns. We also have an M formation, again a breakout to the downside. Okay, we're ignoring, as I said, the green arrows because we're not buying. Reason is we are looking at the overall picture, which is we are in a downtrend. So when you're taking the sell signals, and you can, you know, as I said, take the red arrows in a downtrend as signals as they are, or you can just draw your own support and resistance and trade on the breakouts. You might get in better position that way. Either way, I would be confirming all red arrows with my own market analysis just to avoid signals like this one selling at the low. Okay, here a decent arrow. Again, you could have entered in on the trend there and there, ignoring the green arrow. Ignore the green arrow. Potential good entry there, even here, and certainly here. But you don't want to end up selling too low. That being said, there's currently a nice breakout of this support level here going on, but we could have been in, you know, we've seen the lower highs here. Okay, red arrow. Again, wouldn't necessarily sell if the red arrow appeared at the bottom of this bar. Wait for the pullback and then look to enter on the breakout. You can just use the red arrow as a gauge for the direction that you will be trading. Okay, good money management. So going back to money management, what I was saying about having the stop loss around 20 pips and then maximizing the move as much as possible. A few reasons why we do that. Okay, because if we have a 20 pip stop loss and then we get excited after this drop down and we say, okay, 100 pips, which is, you know, good by all means, but we exit all of our position, we've left too much on the table because there's a significant move. Once we're in a safe trade, and by safe trade, I mean we could have had our stop loss at break even at least, if not, you know, on the high here. Okay, we can be locking in some profit for worst case scenario. If it turns around, we don't let a winning position turn into a losing one. Okay, you can close part of the position, like 25%, 50%, let the rest run if you want. Or we can just leave it all open and try to maximize the move as much as possible. That way, even if we do have some stop losses, like let's say we got a 20 pip stop loss on average and we take 3 stop losses, let's say 4 stop losses and you're down 80 pips. Okay, that doesn't look great. But then when you catch a move like this for 600 pips, I mean, you're going to be 520 pips up overall. And this is in the space of a month. Okay, so it just goes to show the importance of money management. Obviously, good trading discipline, have a plan. Don't let negative emotions like fear, anger, greed, revenge take over your trading. FOMO, fear of missing out. Just make sure you're controlled and have a good plan like any business. And it's worth mentioning this is a 1 hour chart time frame. Okay, I like the 1 hour, 4 hour, daily, weekly, monthly charts simply because they contain more price data. And from my experience, that means more reliable signals. Okay, you know, if we can get 600 pips trading a 1 hour chart, it means less time chart watching, which is great. Better signals, in my opinion, because of the amount of price data included within them, compared to, say, trying to scalp the 1 minute and 5 minute charts all day long. You're pulling your hair out, you're getting stressed out, you're making mistakes just to try and grab a couple of pips for yourself and pay the same probably to your broker in terms of spreads, commission, slippage, etc. So, you know, I think it's trade smart and not hard. Well, still trade hard and put some effort into understanding, from my perspective, support, resistance, trend lines, and candlestick patterns. And I think that, along with good money management discipline, is a good formula rather than some magical unicorn or crystal ball indicator that someone is selling to you for on the cheap. Okay, but going back to the Donchian Trend Indicator, it can be useful for catching trends such as this one for the reasons we've gone through. You know, as long as you're trading in the direction of the trend, taking those signals and confirming your entry and using good money management. Okay, we'll look at a long, aka buy examples now. So same principles. We had our level of support formed here. Okay, you can see resistance level here, resistance, 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 breakout of resistance, resistance becomes support, and price continues upwards. We had the support, we had the resistance breakout, and we've got the market making its higher lows. So we're in an uptrend. And then once you know you've established the uptrend, you can enter as early as here if you're an aggressive trader. Okay, you can see some traders did that. There's a bit of a bear trap going on here. Bear trap meaning some traders were trying to sell into this downwards trend here, but they're too late to the party. So those who were in, okay, it's quite a significant downtrend. So those who got in earlier would have been exiting their positions around here. Traders would be trying to jump in selling here, but they're too late. Okay, traders are taking profits from earlier on. Traders who sold here are getting their stop loss taken. It just causes this momentum shift in an upwards trajectory, and the price, the market reverses, turns around to the upside. Again, this red arrow here emphasizing why I would ignore signals in certain market conditions. We do see an overall downtrend here, but it's more of a consolidation point by the time we get here. Plus, you don't want to be selling at the low. You've already had that big move down with opportunities here, here. You know, you've had ample opportunity throughout. Could have sold there. You know, could have sold there. Support come resistance. Support come resistance. Okay, there as well. Ties in nicely with the red arrow. Support come resistance. There's no coincidence here. If we want to take it all the way back up to here as well, M pattern, breakout to the downside, support comes resistance, ample opportunity to enter, you know, lower highs, diamond formation. You wouldn't want to be selling at the low here. Okay, even here, this is probably a risky trade just because of the move that's happened before, but that level of support was touched so many times that there was, when it did break out, it was quite a significant breakout. And you did actually have quite a lot of bearish candlestick patterns there suggesting, and the lower highs. So a diamond formation, perhaps this would have been okay. So where was I? Back to the uptrend. That would have been the aggressive entry there. Had we waited for this green arrow, still, you know, it would have been a good entry. I mean, these two entries are not bad at all. Again, a red arrow there, if you can see it. Just emphasizing why I'm saying to ignore trades in the opposite direction of the trend. We're in an uptrend now. We want this trade here and this trade here. We zoom out. Say you get the arrow appear. All of this is green, you know. I'll draw my resistance. I'll wait for a breakout. The arrow is on the time of the breakout. Resistance becomes support. Perfect entry into this trend. As with this one here, exact same scenario. Pullback, breakout, and that's, look how substantial that candle is. You know, traders are watching these levels. Again, in this entry, stop loss below the low. Okay. 50 pips, not ideal, but you could have always put it below this low here, which is 20 pips, which is probably where I would have put it. And as price continued to move up, you can just move the stop loss below the low. So the low there, 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 the low there. And maximize this move. You know, you're looking, you could have got, you know, almost 400 pips on this move alone in the space of a few weeks. Fantastic trading. When you see this consolidation here, and certainly when you see the market making these lower highs, you would have looked to perhaps exit all of your position. You can, as I said on the way, close part of the position to bank some pips. What you wouldn't want to do is, again, get excited, see a move upwards and exit here too prematurely, then you risk re-entering at an unfavorable price point. That being said, this again, a limitation of indicators is I can see a pullback and an entry and a breakout there. Indicator didn't signal, it already signaled earlier on. Same here, pullback, breakout entry, resistance becomes support, and another one there like clockwork. Okay. Even as far up as here, but again, you don't want to buy too high. There may have been an opportunity there. Resistance becomes support. Okay. So yeah, and in fact another one there that the indicator did change there, to be fair, but you know, if traders were just blindly trading that, they would have missed out on opportunities like this one, pullback, breakout. Okay, and that resistance level was actually come support later on, which would have been a good confirmation for this trade. Okay, so as you can see, you don't have to trade the arrows every time they appear. Definitely don't do that. You can, in my opinion, give yourself an edge by just first determining the trade direction and deciding you're only going to trade in that direction. So in this instance, we're only going to buy. Whereas in this instance, we're only going to sell. Okay, then we can use the arrows as a guide for perhaps potential entry points. But I'm going to first want to visually confirm. I'm not just going to sell as soon as I see an arrow in a downtrend. I'm going to want to draw my support in a downtrend and see how price is relative to that. Look for some candlestick formations if there are any. It's not a necessity, but it can give good confirmation and validation to a trade. For example, see here, this inside bar, nice bullish candle completely engulfs the previous bearish bars, quite a bullish signal. Okay, same here. Okay. You got 3 inside up candlestick formation. That's when you have a bearish candle followed by a bullish candle, which is at least 50% of the bearish candle, and then a bullish candle that breaks above the high of the initial bearish candle. Okay. So yeah, and good money management as well. Like I said, if you time this, if you take this trade here, in theory, this should be a great trade. Okay, 20 pips stop loss, but you exit, you get excited, you exit here for 40 pips. Oh, 1 to 2 risk to reward ratio, 40 pips up, happy days. But then you leave all that on the table, and then the next trade you get wrong and you lose 20 pips, and the next one you lose 20 pips, you break even. When in theory, if you had taken this trade and exited, let's say when this cost consolidation was around 320 pips, okay, you're up 320 pips. So even if the next ones are 2 losers for 20 pips, what are you? You're 280 pips up compared to being break even, and you still took the same trades. Yeah, it just shows the importance of money management. Okay, so hopefully that's given you an idea of how you can implement the Donchian Trend Ribbon in your trading strategy. I do appreciate you watching. If you can like and subscribe, that will really help my channel, and I hope to catch you on the next one.